So labor markets are now cooler than everybody expected. Job openings are now at the lowest level in 3.5 years, which means that we're starting to see those cracks that we talked about in the labor markets. Now, if you're new to the channel, I've pointed out numerous times that this labor market has been propped up by stimulus. What is leading the way in the labor markets, ladies and gentlemen? It is government jobs, which is a joke. It's services jobs, which is because we have too much money in our pockets. And it is healthcare, which we all know was possibly an overflow from the pandemic that happened. So there's multiple ways that I poked holes into this labor market, and the labor market is really the only thing that's been holding this market up. Now we also topple in the fact that the 2s to 10s are pretty much flat at this point in time, meaning yields are starting to normalize. And what do we know on this channel? When yields normalize, you most likely have a market top in place, or at least forming a market top. Now, I still believe there is an opportunity to take out recent highs after the first rate cut, as we lined up with 2007 to where we are today. That usually is the knee-jerk reaction. But as we can see here, the 2-year sitting at 3.772, while the 10-year is sitting at basically the same at 3.77. We're also starting to see markets are now down roughly 2% over the last 5 trading days. And if you've been subscribed to the channel, I said basically September 1st to about the mid to end of September, we're going to call it 3 weeks. So call it September 21st to about the 25th. I thought we would see between a 4 to 10% pullback in this market. We've talked numerous times on the channel about positioning during yields starting to normalize and the fact that we're trading at pretty ridiculous valuations when we look at it from a historical standpoint. What are some areas we kind of want to be focused in on to possibly be buying the dip or taking profits in some of our financials and technology move here? As we all know, financials have been a massive outperformer. Technology's been a massive outperformer. Where do we want to start taking these profits and redistributing to maybe some undervalued assets and possibly protect some downside risk here is going to be areas like healthcare, consumer staples, and utilities that pay dividends, don't have a tremendous amount of price action, but we're locking up some of those gains and we're trying to really preserve capital in a downward market. Now, as I stated before, I do think it's only going to be downwards probably for the next 3 weeks. It's going to be choppy. It's going to be very unclear on what's going on because some people think it's going to be a soft landing. Some people don't believe it's going to be a soft landing. If you believe it's going to be a soft landing, then you definitely want to stay on the stage 1 early bull cycle curve here. A lot of people are projecting that this is just an extension of a bull market that we're seeing, and this is just a breath. And I can understand that, but when we look at valuations, I can't get behind it, especially when we see the labor markets toppling, and especially when we see yields now normalizing, which is a red flag that we could be getting a top in this market. Might not be today, might not be tomorrow, but probably over the next 6 months, the market top is in, and it's probably the most gains we're going to see for substantial time here because I do think there's some big problems ahead. Now, I want to still use the same time frame that we just talked about, the 5-day time frame of this market being down nearly 2%. And what are we seeing that's actually leading the way here? Healthcare, ladies and gentlemen, up almost 1%. Utilities up 1.16%. Financials are still moving here, and I think that has to do with yields coming down, but I also think that this is kind of a trap for investors here. Financials have had a substantial move, and I just don't think they're going to have the earnings to keep going with the price action that we're seeing. But where I do see opportunities is possibly consumer staples and healthcare, still been a pretty substantial lagger. Over the last 6 months, though, utilities is up 23%, so this move is getting pretty exhausted here. But when we look at consumer staples up 11.5% and healthcare only up 7.22%, you guys can kind of see here that healthcare is kind of where I'm leaning towards, and the recent sell-off of energy. I think healthcare stacked with energy is actually an interesting setup to kind of hide some money here. As we see, energy's only been up about 2%, and we're starting to see oil prices really tumble here, but I think at some point in time, we could start to see stabilizing and we can actually see energy go the opposite direction. So the 2 sectors I'm kind of looking at personally is definitely going to be the healthcare and energy. Now what I want to pull up is exactly where we're hitting on this chart here. As you guys can see here, we have the October low of about 409 on the SPY. And we had just a beautiful rally and maintained this uptrend until about a few weeks ago here where we got some negative configuration. Now, what I want to point out is the bars that you guys are seeing here, these are not green buying bars. This is momentum. So this means that the momentum is good to go. The momentum is very bullish. Yellow means it's neutral, and red is obviously that momentum has stopped and you have to pay attention to a possible correction coming. Well, there's nothing really telling us that we need to pay attention to a correction except when you look a little deeper on the charts here. I pointed out numerous times that I thought we could be forming a double top, and to me that's basically what looks like what's happening here, and I do think we're probably going to catch a bid under this white line, right around a 2.5%, right around a 2.5 to 3% downward move from that rejection from that trend line here. So clear uptrend that was broken, we can see it here. We bounced our head on that trend line, and now we're momentum is now kind of shifting down here. MACD is now starting to cross over and possibly point down. We want to get confirmation on that. So a little bit more selling's most likely going to give us that confirmation. And so while we've had about a 2 to maybe 3% downside move from my projected 4 to 10% move, as we can see here, the market's just starting to shift momentum. We went from a positive configuration now to turning into basically a neutral configuration, which I do believe will turn negative, and we'll probably find some sort of support right around the 200-day moving average is where I think we'll find support. And that is roughly a 7.5 to 8% move downside, which puts it in the wheelhouse of that 4 to 10% move that I've been talking about. But what I want to point out is most people did think we were going to go into a recession in 2023, and most people missed one of the biggest bull runs we've ever had. So majority was wrong in 2023, and now majority believes that we're having a soft landing in 2025, which tells me just do the opposite of what majority usually thinks, and you're probably going to actually outperform. So meaning when you think you should be selling because the market's just completely crap in the bed and things are down 20 and 25% and everybody's scared, and 90% of people don't want to put their money in the market, that's probably the best time to be buying. And I actually want to talk through a strategy I want you guys to use going forward now, okay? So stay tuned for the strategy I'm going to drop here. But what I want to point out is you're essentially betting against history here, guys. Once yields normalize, we're going to get that top in the market. We're going to get that optimism that the Feds are cutting rates. This is great for equities. There's less places to put money. Earnings are going to grow better. And so what I want to point out is every time that we get those yields normalizing, about 6 to 10 months later, we're probably going to see some cracks and a possible recession coming. Now, we don't even have to say recession, but is it believable that we should get a substantial pullback after this rally? And I think the answer is yes. Now, if the labor markets teeter and we have an absolute collapse in labor markets, which I do think is on the forefront here, then I do think a recession is absolutely a possibility and most likely a probability. So in my opinion, ladies and gentlemen, probabilities are that if I were to grade it out, I would say that there's about a 60% chance for a recession in 2025 and about a 40% chance of a soft landing. So that's basically how I would grade it out. Now let's talk through some strategies, as I've given you a couple sectors to kind of keep an eye on here. I also think the gold miners, if the gold miners keep selling off, this could be an interesting play as well, especially if they have true fundamentals and true earnings and good balance sheets behind them. I think gold miners are pretty interesting because they haven't really caught up to the actual asset of gold prices. But here's what I want you guys to pay attention to. Really start focusing on the VIX here, because the VIX is starting to tell us that something is not right. We're starting to see an elevation in the VIX, which is allowing us to know that complacency is actually starting to fade here and people are starting to get a little nervous. So now I want to talk through how we're going to use the VIX going forward. As you guys can see here, the VIX is up 48 to 49%. I was recommending buying the VIX around, I think it was $11 to $12 about 6-7 months ago for just some insurance. And if you listen to that advice, you guys would be cashing in and probably doing pretty substantial if you were going defensive as well. To pay attention to, is now the time to stop buying stocks? And the answer is no. We break down valuations because we believe that valuations in the end will eventually matter. So we're not going to stop doing that on this channel. But what I want to point out is what we need to stay focused on is these big spikes in the VIX are good times to average into positions. So when the VIX is cooling off and markets are going to newer highs, steadfast, reinvest your dividends. I wouldn't sell anything. But when we start seeing these big spikes in the VIX, once we get above 25 and 30 on the VIX, this is usually a pretty good opportunity to start adding the names that you really, really like, because most likely it's going to be the baby thrown out with the bathwater, meaning that your opportunities are probably going to go completely on sale because the market as a whole is selling off. And when we get max capitulation in the VIX, it's usually a good time to start averaging into positions. So when there's max fear and everything's selling off and you've done your fundamental analysis and the stock price is essentially lining up to where you think value is, this is a great time to add into some positions you really like. So use the VIX as a metric to when you should possibly be looking to add into newer positions, because right now with where the stock market is trading, it's extremely elevated, it's extremely expensive no matter how you want to slice it. Well, if you break down the S&P 500 to this and you look at most of the S&P 500 trading at 10 times earnings, it's cheap. And yes, that is true, but we don't live off of those standards. What we live off of is how the S&P is diversified, meaning that the top 10 names are just as important as the bottom 490, and when those sell off, most likely the 490 are going to sell off as well. Leave a comment down below. Let me know if you think this jobs opening is a sign of worse things coming, and let me know if you think there's a soft landing coming or a hard landing coming. And when I give that time frame, I'm talking about a little over a year from today. What are we really going to be looking at that point in time? Because I do think it's going to take time for some things to start showing themselves. And guys, commercial mortgage-backed securities is definitely going to be one of them.